Ladies and gentlemen, boys and girls, in today's video, we are going to be talking about Coca Cola. Now, the company just recently reported that they've hit a 52-week low in their stock price. Now, if you are a value investor such as I, this might present an interesting opportunity to get into this business. So in today's video, we are going to be investigating Coca Cola, see what they're doing right, what they're doing wrong, and find out if the company is a buy today. So what I'm going to do, folks, is first I'm going to load up Yahoo Finances, just get the general gist of what this company has been doing. Over just one day, it's been down 5%, but year to date, I believe that decrease, it's not showing up here, but I believe it's a 15% decrease. Now, it's not all doom and gloom with Coca-Cola, because look, you just scroll down here, and over the last 4 quarters, we've essentially beaten or met all of their earnings. So they bet it in the last Q3 of 2022, they met it in Q4 of 2022, they beat, and the next earnings are going to be reported on October 24th. So that's coming up, it's around the corner. But I think the major issue now with Coca-Cola is that they're slowing down in growth. Let's see what they're doing right and what they're doing wrong. I'm going to need some help from the stock spec software. So I'm going to put in the ticker symbol KO. Load, and what this software is going to do, folks, it's going to load up the entire profile of Coca-Cola, their balance sheets, everything, and all the other calculations that makes this company run. So we're into the Coca-Cola company profile here. So here's the thing with Coca-Cola. On the financial valuations, they're getting ranked a 6 out of 10. So what does that mean, folks? Basically, what this software is taking a look at is the financial strength of the business. What have they been doing over the last 5 years? Are they hitting certain trends? How strong are they in the balance sheet, the cash flow statement, and the income statement? These are all important metrics that you should be looking at as an investor, because not to say that past performance is indicative of future performance. However, it's good to see what foundation are they laying down, so you know exactly what you're getting into, and if there's any problems to arise. What we should be looking for, folks, is the downsides of the company, not the upsides, because as Peter Lynch says, the upsides will take care of themselves. As investors, we have to look at the downsides of the business. So what are those downsides? One being the price earnings ratio sitting on an average of 28.66. For a very, I guess, mature business, it's interesting to see a company trading at such a premium being at 28.66 for what the company has been doing. Now, currently, the price earnings ratio is at 21.60, so it's come down quite a bit. But they're getting a point deducted here, folks, because of the fact that, well, essentially, you're paying somewhat of a premium for those earnings. 22.5 and below is what we're currently looking for on average, and Coca-Cola isn't it. Also, the current ratio is sitting at 1.14. Now, the software would award a point for that if it was at 1.5 and higher. For those who are new to what a current ratio is, essentially what that is the liability coverage, so the asset to liability coverage. A 1-to-1 ratio means that you have just enough assets to cover those liabilities. But ideally, what we want to find, folks, at minimum, 2-to-1 ratio is great, but a 1.5 ratio is also decent, because that means that 0.5 is just a margin of safety for business in case you have to liquefy some positions. 1.5 is great, 2.2-to-1 is even better. Currently, Coca-Cola is currently sitting at 1.14, not the best, as well as, which is probably the most concerning thing on this list here, is their massive debt to equity ratio sitting at 162% and 0.41. Now, what does that mean, folks? That means they are essentially funneling their operations, or fueling their operations rather, through debt rather than taking on equity. Now, in a low interest environment, this would be probably manageable, and one could say, you know what, I can overlook this. This is fine, because there might be enough free cash flow on hand where they can cover this. Now, as interest rates rise and that debt becomes now more expensive, a high debt to equity ratio is a really massive red flag. And to me personally, makes me extremely uncomfortable. I like to find companies that have a debt to equity ratio of 50% and lower. Ideally, if you're fueling the business through equity, that is where you want to be. Coupled with the fact that they've also been diluting shareholders, not by a lot, but the fact of the matter is 0.3% of the total share count has been increased over the last 5 years. So essentially, if you've been holding on to this business like I have, like Warren Buffett and all these other investors, you essentially own a fraction, a little bit less of the business now, because your pizza slice, if you imagine the whole company as a pie, your slice has shrunk a little bit because they've been issuing out more shares. Not a crazy amount, but an increase nonetheless. So the two major red flags here, I mean, the biggest one is definitely the debt to equity. Share dilution is manageable. But the current ratio, especially with this high interest environment, those are the two main concerns that I have with this company. Now, comparing the company metrics to one another, there hasn't seemed to be any kind of drift. Like, yes, the PE ratio is down from the 5-year average, which is great. Their EPS is up from their 5-year average, phenomenal. The return on equity is sitting extremely solid at 42% on the trailing 12 months and 41% on average. That is phenomenal. We love finding companies that have a great trend of having a return on equity above 15%. That is what we want to see. Profit margin still in that similar range. So nothing has really changed too much with Coca Cola. And they scored a perfect 9 on the Piotrowski score, which is great, as well as a decently high Almond Z score. For those who are new to the Almond Z score, essentially is a metric to measure the risk of bankruptcy with a business. Anything above 3, you are safe. 1.8 to 3, you are in a gray zone. At anything below 1.8 means a distress zone for that business, and you should probably stay away. So Coca-Cola, phenomenal Piotrowski score, no risk of going bankrupt. It just seems like the share price has been suppressed. And it just very well be the fact that, look, we're going to probably anticipate some very slow growth numbers going forward. It's a mature industry. It's a worldwide phenomenon company. Everyone knows Coca-Cola. It's a staple American brand. How much more can this company grow? So once we go to the price analysis section down here at the bottom, that is a section where we're going to have to figure out, okay, how much can this company grow going forward? And it's going to probably be a really slow amount. So what are they doing right? As I said earlier, the return on equity average sitting at 41%, phenomenal. We'd like to see that. Their EPS growth is up. We'd like to see that. Their net income is up, free cash flow is up, return on the revenue growth is up, even though it's by a small amount. It is up, and return on invested capital average is sitting above a whopping 10%, sitting at 13.58. That is great. So they're making improvements in all those other places. So it's pretty good. Just the biggest problem for me is their debt to equity. I feel like that could be a problem down the line. So let's see how much of a problem that is, considering the fact that their 5-year average free cash flow is at $8.8 billion. Currently, it's at $9.49 billion. Now, if we go over to the balance sheet, now you can't really see here. There is a drop-down menu, but I'm going to go to the annual basis. I'm going to scroll down to total debt. Total debt. So it's $39 billion. Now the debt has gone down back from 2013, 37. So it was sitting around the $40 billion range. So this is the problem I have with Coca-Cola, is that right now it's at $39.15 billion. Now I like to go through total debt, not net debt, but what we could do with our free cash flow is pay down that debt. Now currently it's at $8.8 billion on average. Now they can use that. Now keep in mind, folks, it's actually not really $8.8 billion because they also pay a dividend. $3.47 billion get paid out, and that's usually from their free cash flow, and that is $7.6 billion being paid out of their $8.8. So realistically, what do they have? They have probably $1.2 billion on free cash flow on average that can be allocated towards other operations in the business. So one of those things being the amount of debt they have outstanding. So $1.2 billion, let's call it $1 billion, to pay off $39 billion of total debt. They can really just chip away at it. It's gonna take a while. But if they don't fix this debt scenario soon, this might be a huge potential issue. That's something to look deeper into. I got to see what the exact scenario is. But with this high debt that they have and the low free cash flow that they have on hand, because a lot of it's being allocated towards the dividend, it's going to probably put me away from the stock. I currently have a position, but now let's figure out what we should be paying for this business if it's in that price range. But the fact of the matter is, this debt scenario, not looking good. And the fact that there's going to be slower growth probably in the future, also not looking pretty good. So let's go here to the price analysis section. And if you're enjoying the video, folks, hit that like button and subscribe button. It means a lot to me. It means a lot to the channel. So I'm going to do some revenue growth numbers. I'm going to hit 10 years of analysis. Now I'm done. What I'm doing here is I'm looking at the historic numbers. And for every single year going forward, I've done 3, 4, and 5. So this is going to be on my column for my conservative, moderate, and aggressive. And I'm really just trying to play with some numbers that they've done and try to anticipate. This is the most important one, the revenue growth. And just try to anticipate what I think this company might be able to achieve given the current low growth rates ahead. So we're going to do that. We'll keep the price to free cash flow pretty moderate given the circumstances that they are sitting in the 20s range. And I'll do a desired return of 13%. I'm going to click calculate, see what the software spits out. But yeah, I'm liking everything else over here. And just while that calculates, what I'm going to do though is just jump over to the income statement. Go on an annual basis and just see what that revenue is looking like. So yeah, so revenue it actually dipped, if you come to think of it. It dipped from 2016 to 2017 and kind of rebuilt itself up. But we're still not, the most amount of revenue they made was in 2013, 10 years ago. That's concerning. Anyways, scrolling back here. Yeah, so the current share price is $52.43. Average calculations comes out to be $36.85. So if you pay $52 for today's prices for Coca Cola, definitely not worth it. I mean, if it wasn't evident enough, not saying the price earnings ratio is a dead giveaway, but you are paying a little bit of a premium for this business, as well as you have to try to factor in the lower growth rates going forward and the massive debt that this company has on hand. Even if the company's stock price was in that range of $36, I'd still probably stay away from it. I have a position, and yeah, no, I can't justify unless they get their debt scenario under control and lower that debt to equity ratio and the amount of debt that's outstanding, then that would look more appealing to me. Anyways, folks, that's the video. Currently, Coca Cola sitting at $36 on average is what a fair value of what this business should be at. It's at 52, currently overvalued. And if you like videos like this, make sure to subscribe to the channel. There's a lot more videos. I post videos at least 3 times a week. But Coca Cola not looking good so far. I'm gonna hold off on buying more into this company until it gets down to at least $30 and they fix the debt scenario. Anyways, folks, that's the video. As I said, hit the like button, subscribe button, 7-day free trial for the stock spec software. If you follow the links in the description box below, use the code FOUNDER to get 20% off for your entire subscription for life. It's a brand new software, so there's a lot of updates that are going to be integrated along the way. But there's 10 years of financial data, the stock spec page that has all the intrinsic value calculators and comparative metrics, along with charts and everything else that I haven't showcased yet. But there's more features going to be integrated on along the way. And essentially, this is a cost-efficient way of analyzing companies quickly and effectively that won't break your bank. If anything, it'll make your bank account a little bit more fatter. Anyways, I'll see you in the next one. Thank you so much for watching.